Today we will discuss subject to transactions. What is a subject to transaction? Well, it's a situation where the buyer buys the property from the seller and there's a current loan in place already on the property. The seller has, had applied for a loan. The property has a loan on it. The property is secured by a mortgage. And the seller is now selling the property to the buyer, keeping that previous loan in place. The buyer is not having to qualify for the loan itself. They're just agreeing with the seller that they're going to make payments after closing on that loan. Those payments will include principal and interest and taxes, insurance, any escrows that might be involved. It helps the buyer because the buyer doesn't have to qualify for the loan. Lots of times the buyer may be a business professional, a business owner, a real estate investor. They just don't have the ability to qualify, or it would be marginally marginal that they would actually qualify for a new loan on a piece of property. Investors are limited. They normally cannot have more than a few loans, maybe 4 or 5 loans on properties, and then lenders become a little cautious about giving them financing. So instead of having the buyer apply for new financing, they take over the current financing. In this case, when the buyer is taking subject to, they are not qualifying for the loan. They're not assuming the loan. An assumption is where the current lender will qualify and accept the current buyer. They will keep the loan in place. They may charge additional fees and so forth. They do require credit and their credit review of the buyer. And in that case, in an assumption, they relieve the seller of the obligation, meaning they will release the current seller and they will now have the buyer step into the shoes of the seller. In the case of subject to, the buyer is not stepping into the shoes of the seller as far as the lender is concerned. The lender is not involved in the transaction. Typically, you go to closing and the buyer will, just assume paying all the fees and so forth. Title will be transferred to the name of the buyer, and the seller will, still be required to deal with the lender if, in fact, there are any defaults. Okay, and the foreclosure action will name not only the current party in possession, but it will also name the previous seller. Okay. The risks to the buyer, or the disadvantages, I must say, to the buyer are that if the seller decides to foreclose or execute, foreclose based on their due on sale, meaning there's a due on sale clause in every mortgage that states that the lender can foreclose if in fact any interest in the property is transferred to a third party. If the mortgage is kept current, if the insurance is kept current, if the taxes are paid and so forth, normally the lender does not care who pays the mortgage, and frankly, they're more interested in just getting paid. It's not their business to take possession of property and put it on their books. It costs them a lot of money to manage property and to hold property. So they normally will exercise that due on sale clause if in fact there's some default that they're aware of. It's very important for you in the transaction to do it right and to make sure that you as a buyer are still continually able to interact with the lender on behalf of the seller.